Hey everyone, and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are diving into a topic that doesn't get nearly enough attention from retail investors, but honestly, it should be right at the center of how you think about investing. We are talking about portfolio hedging strategies. Now, if you've ever watched your portfolio drop during a market downturn and felt that mix of stress, frustration, and maybe even regret, you're not alone. Most investors go through that at some point. The problem is, many people focus almost entirely on growth. They are thinking about what to buy, what's going up, what could double. But they are not thinking about protection. And that's exactly where hedging comes in. So let's start simple. Portfolio hedging is about reducing risk. It's not about eliminating losses completely, because that's just not possible in investing. Instead, it's about managing risk in a way that keeps your portfolio stable enough so you can stay invested over the long term. A helpful way to think about this is insurance. You insure your car, your home, your health, not because you expect something bad to happen tomorrow, but because you want to limit the damage if it does. Hedging works the same way inside your portfolio. If you heavily invested in stocks, for example, you can hedge by adding assets that behave differently. You can use financial tools that actually gain value when markets fall. Or you can simply keep part of your portfolio in safer assets. The goal is not perfection. The goal is resilience. Now, why does this matter more than ever today? Well, markets have changed. They are faster, more connected, and often more volatile. News spreads instantly. A geopolitical event, an interest rate decision, or even a single earnings report can move markets sharply within minutes. That's why portfolio hedging strategies are becoming essential, not optional. Let me break down a few key reasons. First, volatility is now the norm. Big swings up and down are part of the landscape. Hedging helps smooth those swings. Second, emotional investing is a real risk. When markets drop, fear kicks in. People panic sell. They exit at the worst possible time. But if your portfolio is hedged, those drops feel less extreme, and you're more likely to stay calm and stick to your plan. Third, capital preservation. This is huge. It's not just about making money, it's about keeping it. Avoiding large losses can actually improve your long-term returns more than chasing high gains. And fourth, opportunity. When markets fall, opportunities appear. But you can only take advantage of them if you have capital available. A hedged portfolio often gives you that flexibility. All right, so let's get into the actual strategies. We'll start with the most important one, and honestly, the one most people underestimate: diversification. This is your first line of defense. Instead of putting all your money into one type of investment, like stocks, you spread it across different asset classes. That could include bonds, commodities like gold, real estate, and cash. The idea is simple. These assets don't all move in the same direction at the same time. For example, when stock markets decline, bonds often hold their value or even rise. Gold tends to perform well during uncertainty. So by holding a mix, you reduce the overall impact of any single downturn. It's not exciting, but it's incredibly effective. Closely linked to diversification is asset allocation and rebalancing. This is about deciding how much of your portfolio goes into each asset class and then maintaining that balance over time. So you might decide on something like 60% stocks, 30% bonds, and 10% gold or cash. Over time, those percentages will shift as markets move. Rebalancing means bringing them back to your original targets. And here's why that matters for hedging. It forces discipline. You're selling assets that have gone up and buying those that have gone down. It keeps your risk level consistent and prevents you from becoming overexposed to one area. Now let's move into something a bit more advanced, but still very useful. Options, specifically protective puts. A put option gives you the right to sell an asset at a fixed price. Think of it as insurance for your investments. Let's say you own shares worth 10,000 euros. You can buy a put option that allows you to sell those shares at a slightly lower price. If the market crashes, your losses are limited because you have that safety net. The advantage here is strong downside protection. The downside is that options cost money. You're paying a premium for that protection. So if you use them too often, it can reduce your overall returns. For many retail investors, it's best to approach options gradually. Learn the basics, start small, and build confidence over time. Another strategy that's more accessible is using inverse ETFs. These are funds designed to move in the opposite direction of a market index. So if the market falls, the inverse ETF rises. This makes them a simpler way to hedge without dealing with complex derivatives. For example, if you expect short-term weakness in the market, you might allocate a small portion of your portfolio to an inverse ETF. That way, if your main holdings drop, the inverse position helps offset some of those losses. But there's a catch. These are generally short-term tools. Holding them for long periods can lead to losses due to how they are structured, so they need to be used carefully. Now, let's talk about something very simple, but very powerful. Cash. Holding cash might feel like you're not doing anything, but in reality, it's a strategic decision. Cash reduces volatility. It gives you liquidity. And most importantly, it gives you options. During a market downturn, investors with cash are in a strong position. They can buy quality assets at lower prices while others are forced to sell. So while cash doesn't generate strong returns on its own, it plays a critical role in a well-hedged portfolio. Another important piece is safe haven assets, especially gold. Gold has a long history of performing well during times of uncertainty, inflation, and geopolitical tension. It's not perfect, and it doesn't always move opposite to stocks, but over time, it has proven to be a useful hedge. Even a small allocation to gold can improve your portfolio's resilience. Now, if you're looking to go a bit deeper, there are more advanced portfolio hedging strategies. There's sector rotation, where you shift investments between sectors based on economic cycles. There's currency hedging if you're investing internationally and want to protect against exchange rate movements. And there's exposure to volatility indexes, which can rise when markets become unstable. These approaches require more knowledge and active management, so they are better suited for experienced investors. Now, we need to talk about something that often gets overlooked: the cost of hedging. Hedging is not free. Every strategy comes with trade-offs. You might reduce your upside during strong bull markets. You might pay premiums for options or fees for ETFs. And if you hold too much cash, you might miss out on potential gains. So the goal is not to hedge everything. It's to find the right balance. You want enough protection to manage risk, but not so much that it limits your growth. And this is where many retail investors make mistakes. Some people overhedge. They add so much protection that their portfolio barely grows. Others hedge too late, after markets have already started falling, when protection becomes more expensive. Another common issue is using complex tools without fully understanding them. And finally, some investors hedge without a clear plan, reacting emotionally instead of strategically. Hedging should always be part of your overall investment approach, not something you do on impulse. Now, the good news is that today's retail investors have access to tools that were once only available to professionals. If you're looking for a world-class, cutting-edge, user-friendly trading platform app to help you implement these strategies, you should definitely check out crystalballmarkets.com/platform. It gives you the ability to analyze markets, execute trades, and manage your portfolio more effectively, all in one place. If you're serious about improving how you handle risk, it's a great resource to explore. And if you want to keep learning, especially in a way that's easy to fit into your daily routine, I'd recommend checking out this podcast at iss.com/podcast/crystalballmarkets. It's packed with beginner-friendly insights on trading, investing, macro trends, and financial markets. It's a great way to build your understanding over time. All right, let's bring this together. Hedging is not about predicting the future. It's about being prepared for uncertainty. The most effective portfolio hedging strategies are the ones that protect your downside while still allowing you to grow over the long term. You don't need to do everything at once. Start simple. Focus on diversification, asset allocation, and building a solid foundation. As you gain experience, you can explore more advanced tools. At the end of the day, Successful investing isn't just about how much you make, it's about how well you manage risk along the way. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.